Welcome to the daily update. This is being prepared Wednesday, February 23rd, where we'll look at the action in the market today and then see how things look for Thursday, February 24th. There's a lot of things going on right now, especially on the Russia-Ukraine front. And from what I'm reading and what I'm seeing, it looks like that's turning into a front. There might be some kind of an invasion coming up pretty soon. The markets don't like that. In the after market and overnight, the futures are down strong. They're down over 2% as I start recording this. I have a screenshot that I will show you. So let's go through the update for Thursday, February 24th. But first, let's look back on what happened on Wednesday. At the open, the futures had been pretty strong during the night. It looked like we were going to have a good solid open. Well, they started to pull back as things got closer to the open in New York. And we did open higher, but there was actually a gap higher at the open. But as we're seeing a lot these days, there was immediate, within a few minutes, selling into strength. And that's what we're seeing right now. This is a very negative environment currently. It doesn't mean we won't bounce, because when everybody starts shifting negative, that's when quite often you want to be looking for things to go positive. But as these different scenarios play out, it's having more of a negative impact on prices than any kind of a positive impact, because it looks like we're getting ready to bounce and then something happens and boom, we lose that advantage. Now, I'm neutral when it comes to the market overall. When I do these videos, I'm not trying to pump up the long or short side. And personally, I play both sides. So I just want to have a good idea of what direction are things going. If we're going up, I take advantage of that. If we're going down, I take advantage of that. If we're going sideways, I take advantage of that. And those are the different strategies, that I implement. But we're really seeing a lot of negativity right now. Now, another thing that people can argue about is, and this is the old chicken or the egg type of discussion or debate. What comes first? Does the news drive the stock market, or does the stock market drive the news? I've heard it both ways. And if you've taken any of my classes, I basically come from an idea that no, the stock market determines the news. You would be very surprised to see that so many times when we get to an important point in the markets, something in the news ends up happening, or something starts in the stock market and then it carries over into what you're hearing. I'm still going back and forth a little bit as it applies to this Russia-Ukraine situation. I've listened to other people as well, and some people are saying, well, we would be going down right now anyway, even if Russia-Ukraine was not happening. And that might be true. The market's been overvalued for a long time. We've been going up at an almost parabolic state for the last year to year and a half, and the market was due for a pullback. Unfortunately, things have gotten negative, so now we are in correction territory. So is the Russia-Ukraine news driving prices? Yes, to a degree, but the market was already set up for something like that to happen anyway. It was just a matter of when, not if. And this is the normal part of how markets behave. And that's what makes it challenging. It doesn't mean that getting into the stock market is complicated. Buy low, sell high, buy low, go sideways. That's not complicated. It's thinking what's going to happen next, especially when it seems to defy logic. Sometimes that logic goes the way we think it will. Other times it goes against our own logic. And that's why I try to take an approach of let the markets tell us what it's doing instead of putting our what we want to have happen into the market. Anyway, all right, so we did see selling into strength, and that is something that we're seeing over and over right now. That might change at some point, but up till this point, with a few exceptions, anytime we see any kind of a bounce, people are using that as a chance to sell. As the day went on, we saw more buying, took prices all the way back to that resistance level of unchanged, even went positive a little bit. And it looked like, okay, maybe we're going to get a bounce here. Well, what we've seen played out many times over the last few weeks, we get back to that unchanged level, and that just begins another wave of selling. So sellers did enter. We ended up dropping below S1. Then we went all the way down to the January 24th lows. And I'll show that on the charts here in just a moment. Are we going to break below that? Well, it looks like that might happen if we base things on overnight trading that's happening. We might have a gap lower, but as I record this, we're still 6-7 hours away from the open, and who knows what could happen. We could turn more positive, or things could drop a lot more negative. We could also see a real violent move in the overnight market to the point where things get so oversold that we bounce up out of that, and that bleeds over into the daily session. That's what we saw in Katrina. That's what we saw after the 2016 election. Things were really negative when the market was closed, but then when the daily session opened, things turned back positive. We don't know at this point. We just have to watch and see what is being played out. However, on Wednesday, we did close at the low. That's always a negative when you don't see a lot of bounce going into the low, and we ended up being down 1.84%. One thing that you can take from this, volume was just about average. We didn't see a lot of super duper volume in the S&P 500, nor did we see below average volume. The average that I measure, I look back 50 periods and I use an exponential moving average for that. We were right at about the same. So that doesn't mean that there's a lot of conviction. You have a lot of nervousness right now, a lot of people that are confused right now. We should be bouncing. We've been bouncing for the last year. Why aren't we bouncing now? Well, this old buy the dip strategy that had worked for a lot of people is now starting to bite them back. And so that's getting a lot of people nervous, and people that are used to seeing gains are now seeing losses. What we're looking at now are the technicals are negative. And as I go through the charts, you'll see how that plays out. We still have earnings reports coming out. We're still battling with inflation. That's still always in the back burner as far as the US economy is concerned, which goes hand in hand with interest rates. But a lot of what I'm seeing as headline news right now are the geopolitical events, mainly what's going on between Russia and Ukraine. So what are some comments? It hasn't really changed all that much. We're now at the very bottom of that short-term range that we've been in. We've gone back down to the January 24th lows. Russia, Ukraine dominate the news. Canada is still in there too. There was an economic report released that really didn't have much of an impact, and that was weaker than expected. The market is overvalued. If you can believe that, we have to fall a lot more than this just to get back to being expensive. So, and at some point, look at some of the other videos that I have on YouTube, and I will be doing an updated valuation video here pretty soon. Because we're going down, because the current trend has been down, with the down day, we are seeing the ADX strengthen. And so the bias and the momentum, as well as the trend, all continue to be negative right now. But we're getting a little oversold in some areas. So here's one to look at. This is a 50-period rate of change, where we're getting right down here to kind of an extreme negative reading on this chart. As far as sentiment in this chart was out of order. I got my charts mixed up, so we may see this chart again here in just a moment. Fear, you see, starting to get a little bit more to the left. We are in fear territory. If we drop below this little line right here, now we're starting to get extreme. which means people are getting very nervous about things. When everybody gets nervous at the same time, we look at things turning positive. Not necessarily right at that moment, but it gives a good foundation for that to happen. Here's what we're looking at overall. We've been bouncing all around. Well, with Wednesday's decline, we bounced a little bit more. When we get down below this line here is when we start to really take notice. But we could go down, down, down if things continue to fall for quite a while before we actually hit that extreme critical mass point. Here's the VIX. It looked a little bit positive after Tuesday. Well, not so positive after Wednesday. On a closing basis, fear is really increasing. And even though we didn't exceed yesterday's bar, we did close near the high end of the fear gauge on Wednesday. The VIX of the VIX, where it looked like it might be showing a decrease in fear, well, it's still kind of looking that way. It didn't really change much on a closing basis down here. It was flat, but we started off with less fear, and as the day went on, the fear grew. Then this is another one called the Ulcer Index. I have two charts here. This is a shorter term view. As we go down, 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 and people get more and more scared, this indicator goes up, and it has really been advancing. You can see back in late January when this was really advancing as prices were going down. Are we starting to see that again now? And you can see on this chart and all the charts that I show you, we are right at a support level. Now, we broke through some of these other support levels, but we still have this support level to deal with. Are we going to break below that and keep going? Are we going to be able to find some support right here? That's the question right now. Here's a longer term view of the Ulcer Index, and it's going up. And over the last few years, we haven't seen a lot of sustained fear in the market like what we're seeing now. So this would spike from time to time. Well, fear is going up now, but it could still go higher. As far as our different sectors, we had a down day. There was only one sector, that was energy, that finished positive. But discretionary just got hammered. It's back in last place now. Tech got hammered again, down 2.5%. Even a lot of value plays, industrials, financial, utilities, communication, real estate, I mean, everything, just bad. It was a solid down day. And here's looking at it more graphically. Over on the right, energy has still been doing the best since our all-time high. Then way over here in the blue areas where we have discretionary, it's really been getting hit. Here's our Chernobyl green to show us with the communication services. Then the pink for technology and real estate. And they've been dancing around a little bit here and there, but overall, they are down. As far as inflation, the BDI is picking up what's happening right here, but is it being slow or is it leading? That's what we're really trying to figure out right now, but it has really come up over the last few trading sessions. Fed Watch, just to remind you, this is where we were when the CPI came out. This is where we were after the CPI inflation data came out. And this is where we're at right now. We're almost at 83% chance of probability that at the meeting in March, the Fed will raise interest rates by anywhere from 1/4 to 0.5%, or that range. When interest rates go to zero, it doesn't mean 0, 0, 0. It means 0 to 1/4%. And the range kind of floats around. The same thing will happen here if they raise interest rates. Then to look at it on a more historical basis, we are seeing the 1/4 to 1/2 going up in probability and the 1/2 to 3/4 going down in probability. Technical alerts. Well, look at the beginning, the Nasdaq was doing pretty good. It went above 13.4, then 13.5. Well, then it started to take a dump and went below 13.3, 13.2, 13.1. Communication set a new 52-week low. And as far as we're concerned, the S&P crossed below 4,300. Here's our intraday chart. Over here on the right, we did gap higher. We initially saw some buying coming into the market, but you see an awful lot of red after that. Selling into strength all the way down here. We ended up going negative. There was an attempt to rebound, actually took us back to the unchanged level, went a little bit positive, but later in the day, and this is why I wait to set up my trend-based strategies until later on, you might have got in right here thinking, okay, here we go. Well, we ended up just tanking after that. We camped out along S1 for a little while before breaking below that. We went down to, this is the previous low, this black line here. We actually went a little bit below that, but we're right in that vicinity right now. Then looking at this on a daily chart, here's the intermediate term support that we have now broken through on a closing basis. We're right at a pivot level. Are we going to go below that? Are we going to find some support? That's the question right now. But we're right back to this previous low that we set. And you can see down here where the average that I have and the volume are right about the same. We continue to be in correction territory, and with a down day, we're even further into correction territory. On a closing basis, we are down 11.91% since the all-time closing high. Growth is declining, value is increasing in this battle that is being played out. Also looking at the indexes, growth is seeing weakness, value is seeing strength. Nasdaq 100 versus the S&P 500, the tech stocks are just getting hammered. As far as our trend, since we saw a down day, the ADX is turning up, it's above 20, the red line's on top. It's not showing a real strong trend, but it's about ready to break above 30, and that would be a pretty significant trend. Then the mass index, we're still kind of waiting. We have both signals in place here. We're at kind of a hovering point. You might want to default at this point that we might be breaking down from here, but you never know. Something really good could happen. It could switch things around a little bit, and we might be able to say, looking back on this, oh, we had a nice little double bottom here. Sure, I just got in when we went back down here, retested that low and go up. That's another thing that amazes me. When we were way up here in January and people come on, that's why I don't watch the financial media, because it's pretty much a waste of time. You might get little tidbits here and there, but overall, it's just it'll do you more harm than good, in my opinion. I look at charts, but up here, people are saying, yeah, we hit all-time high. Well, where do you think we go from here? Well, we might go retest the lows that we set back in the fall. Well, when they say that, they just kind of throw it off as it's no big deal, that it's just a normal thing that will happen. Well, look at what we've been through. Screaming down, bounced up a little bit, screaming back down now. Now we're on the potential of a verge of war between Russia and Ukraine. People don't have the same attitude when prices are down here that they had up here. So when somebody tells you yeah, we'll retest the lows, we'll go do this, we'll go do that, it's like a politician telling you this is going to save $10 billion over the next 30 years. I mean, it's useless information. It might sound good, it might make you feel all warm and fuzzy, but it's completely irrelevant information and won't play out that way. Because once you get to this point, everything changes. Your emotions change, the way you view things change, and this really makes you take on a whole different strategy and a whole different approach to the market. Okay, then our Arun, this is showing a real increase in downward pressure. Yesterday when I showed this, the red line had been declining and I saw that as potentially positive. Well, with the decline, this has shot all the way up to 100. That means sellers are in control as of the close on Wednesday. Buying went pretty much sideways, and when you take the difference between the two, we are below this zero line with this oscillator going down. So this is a pretty negative picture based on what we're seeing on this chart. The decision point signals have not changed. The PMOs are down on short and intermediate term, up long term. As far as our breadth, it continues to show weakness. We're starting to see more follow through weakness based on price. We're dropping below this moving average. We're seeing a pickup in the strength of selling based on volume as we continue to trail off, and the red line is rolling over. The advanced decline ratio, we are dropping as could be expected, and we're getting into potentially extreme negative territory. But this could still go further. The last time we were down around here, well, we got in here in January, but when we really hit this was during the COVID plunge. But we were able to bounce up out of that. Things are a lot different now than they were back then, at least as far as our climate. Then the new highs, new lows, we're seeing a lot of new lows being generated, which means both of these lines are decreasing. Accumulation distribution, it dropped below the moving average. Now we'll have to see if that continues and if this red line starts to go down. Short-term charts were way below the 20-period moving averages. Our moving average studies were showing an extreme reading on the 20. We're going lower on the 50, going lower on the 200. Our moving average spaghetti chart, yeah, we're right down here, but it's just looking like static electricity up here now. It's all tangled up. MACD is decidedly negative and with still more room to go down. The STO, which finally seems to be making a little bit of sense now. It picked up on this decline on Wednesday and is shooting lower based on price and volume. The McClellan oscillator is also negative and in an extreme negative territory, but could still go further from here. Shorter term indicators, the Stochh RSI is pegged negative, and the Williams percent R is pegged negative as well. Force index is continuing to show weakness, and it's getting near the lower end of this Keltner band here that act a little bit like Bollinger Bands. Intermediate term, we're way below the 50-period moving averages, and they're both going lower. PMO going negative and starting to get into an extreme negative reading, and negative based on price and volume. Our other study, those that are rising, is getting extreme negative. Then those that are giving buy signals continues to decline. Those that are even positive is declining. BPI, we had a down day, so we saw more point and figure sell signals. And this is starting to just go down about to where we were a few weeks ago. Moving average rainbow, price is now dropped below the rainbow. So you can start to see some of these lines cross. Stochastic short term, we are in oversold territory, intermediate oversold. The longer term stochastics, it still has more room to fall. Summation index also getting to kind of an extreme point where we're negative based on price and volume, with volume leading the way. All of our oscillators are now negative. The short-term oscillators that we look at, intermediate term and long-term, have all pretty much crossed negative now. We're losing the Pring bottom fisher signal, potentially. Now, this could turn back up if we see some positive price action, but it generated a signal here that something should happen and nothing has happened. So it is now beginning to roll back over. Vortex, red line going up, green line going down, showing overall negativity. CCI pegged extreme negative. Here's another rate of change, a 5-period. This is showing a pretty extreme reading right now. Here's the 10-period, also into extreme negative territory. And the 50, this is what I put that other chart in the wrong place. We're getting into extreme negative territory. Here's the standard deviation. How far are we falling too far too fast? Well, this thing could really shoot up if we see more of a drop from here. And it's already giving us kind of an extreme reading, but not as high as it was a few weeks ago. Our different trading systems, the Elder system is negative with the MACD declining. SAR also negative. I feel like a broken record again. The Heiken Ashi, black candle and going lower. Kegi chart is looking a little bit more negative. And if we break through the support level, you'll probably see this chart redraw to show that. Renko added another red box after the decline. 3-line break is also looking very negative. Equivolume shows the support that we're at right now, but we are declining on the ease of movement indicator overall. Point and figure added another 0, also showing the support that we are at. Now, when everything lines up negative like this, sometimes at least be open to some kind of a bounce. Doesn't mean that's going to happen, but the trick that I've learned is you always have to prepare for all 3 scenarios at the same time. We're headed down strongly right now. Okay, we know that. It's not hard to see. But what are we going to do if things go sideways? What are we going to do if something happens and we see a pretty strong bounce? What are you going to do then? Be thinking of what you're going to do with all 3 scenarios at all times. Then we fell below this Fibonacci retracement. We were holding up under the 38.2. We broke that. Now we broke below 50. Now we could possibly be heading to the 61.8%. We'll have to see how that goes. Long-term charts. Our arithmetic scale, yeah, we're below the long-term moving average. But if this continues, the red line is going to start to roll over, but it hasn't yet. And we've broken below this before, and we're able to regain things. But we also could be getting into a longer term decline into the markets. Here's our logarithmic scale, also closing below the moving average. Special K is showing a decline. Here's a longer term view of that same chart. Broad market, S&P right at, I don't know if I'd call it, since it's support, I guess it's critical, and the market stopped right at about that level. So yeah, but it's more short term. It'll get dealt with pretty quickly. We're either going to bounce back up off of this or break down below it. Mid caps are still kind of in the messy range, as are small caps. FANG stocks just not doing good. Down over 3% on Wednesday and have broken below support. The Nasdaq's kind of leading things lower, and poor Cathie Wood. This, when she was going up over here, she looked like a total genius. Well, look at her all-time high and look at where things are at now. My goodness. It was, what was it, 160? Was that her all-time high? She's now down at just above 60. Ooh, that's not good. Down in 3.96%. I'm not trying to laugh at her. I'm not trying to dismiss her. I respect her. I don't agree with some of the things she says. I do agree with other things that she says. She's convicted about what she's trying to do, and you've got to respect anybody who's willing to do that. That's where I come out. Whether you're right or wrong, okay, at least you had a plan. And sometimes those plans work and sometimes they don't. The Dow broke through and is right at about the same support level, but we broke through what would that be, S1 on Wednesday. A lot of people are really predicting doom and gloom right now, which when everybody's saying the same thing, that could be, a reason to at least watch things play out before you jump on that same bandwagon. Small caps back down in the range. Still has a bit lower to go before we break out of this range to the downside. Mid caps, kind of the same thing. The Nasdaq, it's just a little bit below where we were, but we have, well, let's see. Now we have our S1s way down here. This is an S level for Wednesday. But the Nasdaq's showing more weakness. We have the cross, we have prices falling, we're breaking support. We could see some potential support right back here that we saw last spring. If we break through that, things could get even uglier. The Nasdaq 100 also breaking support and still has some more room to go down before it hits any kind of significant support, unless it can find a place to turn and go the other way. The Vixen, it was looking more positive on Tuesday. Well, Wednesday, we really closed, but this is the Nasdaq 100. We closed at the low, but here we closed at the high. As far as the fear gauge, NYSE also dealing with support, kind of like the S&P and the Dow are right now. S&P 100 is continuing to underperform the S&P 500. Wilshire also dealing with support, and this is probably the most broad-based measurement of stocks. So this is what the total stock market is tending to do. A lot of people use the NYSE. That's why I look at it. This one mixes and matches from different, NASDAQ stocks, big stocks, small stocks, and so forth. So that's why we want to keep an eye on this chart. Then internationally, China has been having some trouble, emerging markets, Europe having trouble, Japan having trouble, America having trouble. So this is kind of going on all over right now. Our all stocks, they continue to be below the moving average. We're in danger of seeing a potential death cross if we see things continue to decline. Some broad market measurements, surprisingly, we've seen gold going up, but we're seeing the dollar go up too. Figure that one out. Where we're seeing some problems right now is in Bitcoin. And I'll show a chart here in just a moment. Here's the weekly chart. The dollar has been holding up. Oil back into the 92 range. Gold, yeah, it's breaking out. We're getting back to some of these previous levels. So this could be positive for gold if we're able to break above that, or is this going to turn into resistance? Silver finally had a bit of a breakout. This 200-day moving average had been acting as resistance. Well, we saw a breakout on Wednesday. CRB was up under 0.5%, but overall, we continue to just see this puppy climb, which is more of the inflation scenario. Here's Bitcoin. This chart shows it around 38. As I started recording, Bitcoin was down into the 34s. Yeah, we'll just have to see how that goes. If we get down into the low 30s, now we're getting back to some of this really longer term support, and the 29 to 30 level. If we break below that, it could get massively ugly. I don't participate in this market, but I find it fascinating to watch. As far as bonds, we're continuing to show the spread between the 10 and the 2-year declining. 3-month not helping us. And why, you probably wonder, why do I keep putting this chart up every day? I like to look at it every day, and there are some people that really believe in this method of measuring things, and I just want to show that if you look at this chart, it's really just not helping you right now. Here is the Fibonacci retracement from the 10-year yield. Here's the high, here's the low. We crossed above the 50%. We broke through what had been resistance, and we're coming back down. It bounced up a little bit on Wednesday, so this resistance is now potentially acting as support. Looking at our different yields, we saw an increase in the 30, 10, 5, 2, but a decrease in the 3-month. Then internationally, with all the mess that's going on, it's really impacting places like the UK, Germany, with the whole Russia-Ukraine thing. So you would expect to see people getting more into bonds right now. That's called a risk off. But with yields so low and inflation really going up, people are losing money. So we're not seeing that flight to quality that we're seeing. A lot of people are getting more into gold right now as a safe haven. Here's our world bond index, which shows an overall decline, as it has been for quite a while. Corporate bonds saw a decrease in price and an increase in yield on Wednesday. And then this is just a longer term look at this same chart. So this goes back to 83, 84, and the gradual decline of interest rates. So it gives you some historical perspective. Yeah, we're going up, but we've been at these rates before, so they're not necessarily astronomical yet. Relative studies, the one that I'm watching on a daily basis is gold to the S&P, and it continues to break out. And we're looking at a potential cross between the blue moving average and the red moving average. That would give it a bit more strength. So what's our outlook for Thursday? We are in correction territory for the S&P. Other indexes, the Nasdaq 100, they've been in correction territory. I'm just focusing on the S&P 500. And then the overnight futures are down over 2% as I started to record this. In fact, I think, okay, I thought I had a screenshot of this, but I guess I didn't. Sorry about that. But yeah, they're down over 2%. Now, that could change. It could change when I finish this recording. The markets do remain in that short-term range, but we are at the very bottom of that range. If the market's going to make a stand, it's going to need to make a stand pretty quick. There's also probably more stop losses below where we're at right now. So that could look like a real acceleration. Once those get cleared out, once we get later on in the trading session on Thursday, we'll have to see, can the buyers come back in and take control? Are they even going to show up? We're still dealing with earnings season. We're still battling between growth and value. We have weekly jobless claims coming out. We have new home sales coming out. And then we have, this is kind of the biggest one, the second estimate for the GDP going back over the fourth quarter. And if that puppy turns negative, that means we're in recession land, potentially, because a recession is 2 quarters in a row, negative GDP. That is going to freak everybody out. Now, I have no idea what the forecasts even are for GDP, but if we get some kind of a surprise and it throws the markets into a real fit, I hope that doesn't happen. I really don't, because we're dealing with enough right now, especially with the Russia-Ukraine situation. There are the Iran meetings going on. There's talk about the Iran nuclear deal being back on the table. They're talking about letting Iran sell oil on the open market. And then, of course, there's a lot of interesting things coming out of Canada. So what is our conclusion? The S&P is negative, and it's right at the tipping lower point of that range. And we are now testing a previous low. Short and intermediate term bias is negative. The long-term bias remains positive as long as that 200-day moving average is going up, but showing weakness. We are below that 200-day moving average, and that long-term uptrend is fading. So it could be getting ready to switch over, or we may be able to bounce and recover out of this. So thank you very much for watching this video, and I will talk to you again after Thursday's session.